Pooyan Fard. It's a pleasure to be part of Redondo Mortgage Center. Who's the first-time home buyer? That would be the key question. One would assume that it's your very first home that you're buying, which is not the case. To be a first-time home buyer, all it takes is the last 3 years. You should not have had any home ownership. And let's say if it's a couple and only one of them have like a home within that 3 years, and then they're buying a home together as a joint ownership, then again it would be the first time home ownership. So you would both be on the title, you buy it jointly, and then you would be considered as first time home buyer. FHA loans, we have conventional loans, we do have hard money loans, and then we have the stated income loans. First-time home buyers, we would be looking at either FHA or conventional mostly. Basically, FHA stands for Federal Housing Administration. It goes back to 1930s when government wanted to extend some help in order to ensure loans that the lenders would give out. They were trying to introduce fixed rates, alternative to adjustable rates, and also help other borrowers to buy properties, especially the first-time home buyers. Generally speaking, first-time home buyers, they have less saving, they're just starting up, they need some assistance. So it happens that a lot of first-time home buyers will go for FHA loans. Conventional loans are for those who have higher down payments. It could be as low as 3.5% or generally 5% down. Rate that you would be paying through the life of the loan that you're getting, and it's going to be fixed. It will not change. When the rates go higher or lower according to the economy's changes, you won't have to worry about it. The risk is much less. R stands for adjustable rate mortgage. We will have a floating rate. What it exactly means is you would be sharing the risk with the lender. If the rates will go high, you would be paying higher. Or if the rates will go down, you'll be paying less. There are factors involved in an adjustable rate mortgage. One is the initial or introduction rate. Let's say if the going rate for a fixed rate mortgage is 3.5, they offer you 2.5. So that period would be, let's say 1 year, 2 years, you'll be paying a lesser rate, and that helps you to save money for the future. Then they have adjustment periods. So let's say a quarter of a year, you will have the rate adjustment, and then rate adjustment has a couple factors. One is the rate. They use different indexes like LIBOR or COFI. APR, annual percentage rate. Your annual rate includes the total rate that you pay all through the year, and mostly it includes all your finance costs. So we also call it effective rate. Here at RMC, we are very upfront and clear about all these differences. We normally focus on the loan rather than the rate, because a lot of times lenders can just downball the rate to convince you they are offering you something good, but at the end of the day, you'd be paying way more. In loan industry, what we refer to as point is a percentage of the loan amount. 1 point stands for 1%. When you charge 1 point, it means 1% of the loan amount. Origination fee, the fee that your loan agent is charging you. There's sometimes this confusion that borrowers think that if they go to the banks, they don't pay that, but they just call it differently, but they charge you the same thing. For brokers, we call it YSP, yield spread premium. Banks call it SRP, service release premium. And a lot of times you benefit going to a broker. It's like just going to a shop where they have only one product, and I would call it a bank. And the second one is you go to a wholesale shop and you have several different products and you choose what is best for you. You can try it on. If it doesn't look good, you change it. Your loan agent will do that. Principal, interest, tax, and insurance. There are times that you have PITIA, and that A is homeowners association on top of your payment, and that's only when you have condos. So it's good to know when you look at your PITI, the total amount you'll be paying, if it's somewhere around the amount that you're paying for your rent. So it means that you're exactly where you are at. It's not a difficult step that you take. Mortgage insurance. most of the time, borrowers, they are putting less than 20% of the property's sales price. So mortgage insurance is just a protection for the lenders. FHA loans, they'll definitely require you to pay an upfront premium mortgage insurance. But for conventional, you either paid upfront or monthly. Impounds are accounts that your lender will require you to have. Your PITI as part of the cash you have to have for closing for lender. Escrow is actually a borrowed French word, escrow, which is a scrap of paper. Third party, they'll distribute the money and all the documents. So I would say the first step would be find your loan agent, get qualified, give them the documents that is required. 2 years of tax return, your 2 pay stubs. If you're a couple, you're in a community estate, so both of your IDs, driver license, social security card, retirement statements, and then they'll qualify you for the amount that you can get a loan, and then move on to looking for property. Here at RMC, we have the pleasure of working with several real estate agents all through the South Bay, because they know us pretty well, and they know when we give you a pre-qualification letter, we mean it, and they don't have to worry about it. When they find a property, you can easily make offers on it and get the loan. For first-time home buyers or any home buyer, FICO plays a very important role. When we run your credit, we basically get your score from all the 3 credit bureaus, and then they'll take the mid score among those 3. First-time home buyer, as I mentioned, if you're going for FHA loans, you can go as low as 0.5% down. 0.5% down for $100,000 is $500. But that amount is not the only amount that you're putting down. It's very good and important to know how much you need for getting a home. And I would say you need at least $5,000 to $10,000 for all the fees involved, like escrow fee, the reserves, tax, prepayments. So if you only have $500, I mean, you got to be reasonable. Even getting an apartment to rent is going to cost you more. First-time home borrowers, as I mentioned, mostly they're newlyweds or those who want to move into their first home. So a lot of times they're couples. So when you're a couple, for FHA, no matter what, the other half their liabilities would be considered for FHA, even though they're not on the loan. So it's good to include them on the loan so that you can benefit from their income as well. For conventional, one can just be by himself. Reserves, we mean those impound accounts that you have to have, and your lender requires you to put it in your impound account. It will refer to your tax or PITI payments in advance that you put in that account in order to get the loan. Hello, my name is Pooyan Fard, and it's a pleasure to be part of Redondo Mortgage Center as a professional and loan consultant.